This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how you and I can build wealth. I mean, that's what it's all about, right? We can build wealth to be financially independent. I'm your host, Justin Goodbread, and today we're dealing with a topic, what exactly is value? Now, as you know, we're in the middle of a series titled Growing the Value of Our Company. The reason why most of us are in business vary. You know, I've heard people say, Justin, I'm a business owner because of freedom. I believe in that. I'm a business owner because I can make a little bit more money than I can as an employee. I agree with that too. I want to have a sense of accomplishment. Man, I'm right there with you on that. And the list continues. I mean, it just goes on and on. However, if we properly plan our business, we can grow a company that has value, that has a value that someone in the future would potentially offer us some money, which we could use to supplement our net worth, our retirement assets, etc. Well, technically, our value of our company would be in our net worth, but we could get the cash out of it and use it for income purposes later on in life. But we must understand what value is. So to illustrate value, I want to take you way back to my elementary days when I began investing in baseball cards. Now, I'm not sure about you. Maybe you never dealt with baseball cards, but for me, there was a period of years where I would go to the store many times with my dad, and we would buy baseball cards. And yes, yours truly today has a couple thousand baseball cards sealed in a homemade wooden box that I've had for years now. And I have baseball cards for many different eras. I can't even remember which different types of cards I have, but I can remember some specific ones. Nonetheless, Dad and I would go to the store and I'd spend my money that I'd worked hard for and buy the baseball cards in the pack. Sometimes I'd buy a whole box. Sometimes I would just buy one pack at a time. But I would get the baseball cards and then I'd run home and I'd open up the pack of cards. And I can remember Dad and I sitting on the ground and we would open up the Beckett pricing guide. Now, for those of you who's ever invested in baseball cards, you may have used the Beckett pricing guide. In the old days, back when I was a kid, you could buy the printed version of the Beckett pricing guide and you could look at your new purchase cards and see what the value of those cards were. So sometimes I would pay $1, for example, for a pack of cards, and you'd open it up and man, you hit the mother lode. You've got a $10 baseball card. It's like, dude, I just spent $1 and I now have a $10 value. Other times, and many times this would happen, I would spend $1 and I'd open it up and found out I only have 50 cents worth of baseball cards. However, even when I had the 50-cent pack of cards, I could go to my buddies sometimes, and as we're trading cards around, I could take that 50-cent card and one of my buddies would trade it for a card that was more valuable. So even though the Beckett pricing guide says, my 50-cent card is valued at 50 cents, my buddies may trade me for a card that's $1. So my question to you is, and I know this is a silly example with baseball cards, but it drives home a point that I want to bring to us is, was the Beckett pricing guide wrong? I mean, let's say I did buy a baseball card that has a value of 50 cents, and me and my buddies would get together in a circle, and they had the same Beckett pricing guide, and they know that the Beckett pricing guide says that this baseball card is worth 50 cents. But why would they trade me a card that's maybe worth $1 for one that's worth 50 cents? Or why would they trade me two cards, one worth 30 cents and another's worth 30 cents? So a total of 60 cents worth of cards for one card worth 50 cents. I mean, they realize that my card is only worth 50 cents, but yet they're willing to trade cards that were more valuable, according to the Beckett pricing guide, than my current baseball card. Was my card undervalued? Was the Beckett pricing guide wrong? Or did the buyer just overpay for a card? See, when we deal with the world of values, you can see that the purchase price many times could be higher or lower than a guideline. We often see discrepancies like this in real estate. We see it in cars. And man, for sure, we see it in collectible trading. I see it in baseball cards in this example. I know it in precious metals like coinage. I see oftentimes that you could have some discrepancy in pricing. Guns. I know people who trade in guns, and you can have some discrepancy in pricing there. And art, fine art. So to understand the mystery behind value, we have to look at the various types of value. See, many times people say, well, the market value or the fair market or whatever the term they use is this. Well, is that accurate? See, friends, there's several different types of values. And today what I wanted to do was to take a minute, slow it down a little bit, and explain what is value and what type of value are we looking at trying to grow in our business. So I want to analyze the various types of value today and then ultimately drive home the point of the value that we're focusing on when we're trying to increase the value of our company and why. So that's what I want to cover today. So let's dive right into it. The first value, and you may have heard of this, and it's a term that's often used, is called the fair market value. So fair market value. Sometimes you'll see it abbreviated as FMV. So it's a term often used, and fair market value is the price that a property or a business would sell in the open market. And basically, it's when a buyer and a seller who are reasonably knowledgeable, so they have a little bit of knowledge, so they're reasonably knowledgeable about an asset, and they're behaving on their own. In other words, someone's not forcing them to do this. Fair market value is what the willing buyer and the willing seller would come into an agreement on. So let's say that I have a car or a baseball card. Let's go back to my baseball card days. This is where one of my baseball cards, if it's priced in the Beckett guide at 50 cents, and I go to a total stranger and they look at my card and they look at all the variables, they realize that it's a 50-cent value. They may offer me 50 cents or 49 or 51. It's not going to vary much. Fair market value is governed by the Internal Revenue Service for those of us in the United States. And it's often used for recharacterization of transactions for tax purposes. In fact, the IRS has a ruling. It's called the IRS ruling 59/60, and it deals with the details governing value. So the way I think of fair market value is oftentimes is used for tax purposes. Another way fair market value is sometimes used, not always, but sometimes used, is in the event of a divorce. Whether it's a business divorce, like where business partners are separating, or a matrimony or marriage divorce. Many times fair market values can be the determining point for valuing the property. Now, ultimately, if it's in a court case, the court's going to decide or the documents which govern it. But fair market value, nonetheless, the way I keep it in my financially simple mind is this is what the IRS says the property's worth. So that's fair market value. Now, it's going to get confusing here, so I'm going to try to keep it simple. Another value is fair value. So we drop the word market out of it. So fair value. And believe it or not, fair value is different than fair market value. So how are they different? Fair value is the sales price agreed to by a willing buyer and a willing seller. So many times the open market or the securities market, those who are trading in stocks or ETFs, etc., the fair value is determined. So somebody will say, I want to trade X stock at $20 a share. And someone may say, I want to buy X stock at $18 a share. And then the market comes to the point where the buyer and the seller agree on it. Now, in a small business like we're talking about, fair value is often used when valuing the 409A stock option. The IRS says, here's how we're going to value stock options. Another time, the accountant may use fair value. They'll use discounting to determine fair value of a piece of equipment. So let's say I have a piece of equipment. Let's say it's a truck or a car, or a boat or a plane or a piece of heavy equipment like an earth mover, etc. The accountant may go in and do some discounting, and that's where they drop the value down for whatever reason to determine the value of a piece of equipment. So that's fair value. If I go back to my baseball card analogy, the only way I can describe fair value, and it's really not a true form of it, I remember after about 2 years of buying and trading baseball cards that I realized that unopened packs of cards. So if I went and bought a Topps card pack that could have 25 or 40, or depending on the size packet that I purchased, cards in it, if I unopened that pack, it had a certain value to it. Now, granted, I didn't know what was inside the pack. It could have had a $10 card in it, and I only paid $1 for the pack. What a fair value would do is we would go to an appraiser and they would discount it using some algorithm or some discounting factor after applying some research. And the appraiser may say, you know what, based on the probability, this $1 pack is probably only worth 70 cents. And so they add a discounting method to it, and then you would buy the pack for 70 cents. Or, depending on a particular run of the baseball card packs, they may say, you know what, this particular series could have a couple of good cards in it, so we're going to add an inflationary factor to it, and this package that you paid $1 for is now $3. And so that's the best way I can come up with a fair value using my baseball card analogy. But fair value is different than fair market value. Like I said, most of the time for businesses, it's going to be used for determining the value of a stock option. That's the most common use of it. Now, let's add even more confusion. So we talked about fair market value, and that's what a willing buyer and a willing seller is willing to do without being forced to do anything. Then we have fair value. Now we're going to deal with market value. So market value is most commonly referred to as the market capitalization rate. Now, we talked about a cap rate at some point in the most recent shows, but here's the simplest way to determine this. So in a publicly traded company, you can determine the market value by taking the number of outstanding shares of a stock. So let's say a company had 100,000 shares of a stock and the current price is $20. So you would multiply 100,000 times 20. So that gives you the value or the market value of that company. In a private business, however, market value is most commonly used in a business auction. It's simply the highest value that a company will receive on the open market. And most of the time it's used in an auction sale. So here's where this comes about. Let's say that you really want to try to figure out what's the most money that you can get for your company. And there's not any strategic buyers. We'll talk about that in a second. And there's not any financial buyers. But you want to take your company out to the open market and go through an auction environment. And this is not uncommon. Well, what's going to happen is you will get various bids back if your company's marketable, and ultimately the price that's agreed on is the market value. So in my baseball card example, let's say I have all my baseball cards and now I give them to an auctioneer, and the auctioneer raffles them off to a group of investors who understand baseball cards. They raffle them off, and each individual card is sold for a set dollar. And so that would be the market value for each of my baseball cards. Now, that's different than a fair market value. So the way I describe market value is think of it in the terms of an auction. If somebody's trying to auction off your company, this is the value that you would receive from that auction.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
So now we're going to deal with a different value altogether. So we talked about fair market value. We talked about fair value. We talked about market value. Now we're going to deal with investment value. See, investment value is the value of an asset to a particular investor. Let's go back to my illustration. Let's say I go back and I grab my 50-cent baseball card that I just purchased in my Topps baseball card pack, and I looked at my Beckett guide and it says this particular card is worth 50 cents. So that would be the fair market value for the card. Some people may say it's the book value, but it could be the fair market value. And let's say I talked to my buddy, Jason, and Jason wanted to trade a $1 card for my 50-cent card. You may say, well, Jason's paying too much. But Jason sees value in my 50 cents card. In fact, he values it as such that he's willing to give me a $1 card for my 50-cent card. There may be a reason for that. He may have his different reasons, but that is an investment value that Jason's willing to pay. Even though the Beckett guide said my baseball card's only worth 50 cents, Jason says, no, I view that as $1. So that's called an investment value. In our businesses, we may have somebody who appraises our company and they say, you know what? I think your business is worth X on paper. And then you go to a potential buyer and they offer you a little bit more money. That's called investment value. In addition to investment value, though, we could have what's called strategic value. And this is one of my favorites. Now, let's say that Jason and I, we're sitting there looking at the cards, and let's say that Jason has the entire Atlanta Braves 2000 baseball team. Atlanta Braves is my team. I grew up in Georgia. I like the Atlanta Braves. I can remember watching some pretty cool games in real time. I wish they'd won more World Series whenever I was a kid. I wish they'd do it again, but I like the Atlanta Braves. So I'm not a bandwagoner, so don't jump on me. But let's say that Jason has the entire Atlanta Braves 2000 baseball team, but he's missing the left fielder. And let's say he's missing the left fielder's mint condition card. And I just so happened to have gotten whoever the left fielder was in 2000. I don't remember. Let's say that I just happened to open up my pack and Jason looks at my pack and he says, dude, Justin has my left fielder for my Atlanta Braves 2000 team. That's the only card I'm missing to complete my entire team. Jason might be willing to pay me $2 for my card. And let's say my card's only worth 25 cents. And again, I don't know who the baseball player is, so if you're listening to this, Mr. Atlanta Braves left fielder from 2000, I'm not saying your card's worthless, but I'm just making it a point. Anyways, so Jason might be looking at my card and he's going, man, I really want that left fielder. I'm going to see if Justin will trade me $2. So he may make me an offer of $1.50. And I'm like, yeah, let me go and look it up on my Beckett guide. And I see, well, man, this thing's at 25 cents. Jason must know that. I wonder why he really wants it. And I may play hardball and I may say, Jason, you know what? Nope. Can't have it for $1.50. I'll give it to you for $2. And all of a sudden, Jason's willing to trade me $2 worth of cards for my 25-cent card. Why would he do that? Well, see, Jason would see strategic value. He would see synergy between my card, which would complete his Atlanta Braves set. The same thing happens in our business. You may have a business that's totally unrelated to a potential buyer, but the potential buyer has strategic value. He sees something in your company that could help them grow their company better. And so you can end up getting a very, very good value for strategic value. That, by the way, is my favorite type of sell on a business to work with. So then we go into book value. And this is one that I want to caution you on. I've seen a lot of people hurt by book value. I actually witnessed a business separation where the attorney, and this attorney was not a business attorney, they went to a litigator, this particular company, before I ever worked with them, before I ever knew any of this information. I was brought in there in the middle of a divorce. They went to a litigating attorney to write a business contract. And that's, litigators are really good in the courtroom. Many times they're not very good in the document side of things. And the litigating attorney put that the company, upon the buy-sell, should they separate, would be valued at book value. Well, here's the problem. Book value doesn't take into account any goodwill. Basically, and I'm overly simplifying this, but basically book value is whatever the balance sheet of the company says it's worth. And it could mean that, for example, equipment in the business could be worthless. So let's say I did this. Go back to my baseball card analogy. Let's say I purchased all my baseball cards, and let's say that somehow I was able to depreciate. In other words, write it off against my income taxes, all my baseball cards down to $10. However, I knew that if I took my baseball cards to an auction, remember that's market value. So if I took my baseball card to an auction, I should theoretically in an open market get about $1,000. Well, if in a contract I was only going to get a book value, then forget the fact that I had a bunch of baseball cards worth $1,000. If the contract said I was only going to get book value, I'd only get $10 because that's how much the book value of my baseball cards would be. So I have seen book value hurt many people in operating agreements and in buy-sell agreements. You've got to be careful for that particular value. But it's very handily when working with lending and working with other things. In addition to book value, we also have a thing called liquidation value, and this is where you're trying to close the company. The way I describe liquidation value, it's, look, I've got all these assets of the company, I've got all my baseball cards, and I'm going to go sit on the lawn of the bank, so to speak, and I'm going to sell my baseball cards on the front doorstep of the bank. So that's your liquidating them. You're just trying to get whatever you can get maximum value. Now, you also could have what's called forced liquidation value. See, in a liquidation value, I could say, you know what, I'm going to sell my baseball cards, I'm going to advertise this, and I'm going to sell them to whomever. But you know what, if someone offers me 10 cents, you know what, I think it's worth 20, I may wait and say, you know what, I'm not ready to quite sell this, we'll try to get another day. Forced liquidation means, no, you're going to sell it on this date, and no matter how much money you get, that's it. So that's like the worst of the worst of the worst type of value you can have. You could also have what's called collateral value. You can probably see by now there's so many different types of value. Collateral value, by the way, is what is a bank willing to lend or what is a lender willing to lend against the assets that you have in the organization. whenever we look at value, we have all those different types of values: fair market, fair value. We have strategic value. We have all these different types of values. Whenever I'm talking about, though, growing the value of your company, I'm not referring to any of those types of values. Now, ultimately, should we end up having to deal with a company in a liquidation, then liquidation value matters. If you end up having to deal with the value of your company in the event of a divorce, a partnership divorce, or a marriage divorce, then those matter. If we're dealing with some sort of an accounting for 409A type measurements, then those particular values matter. But what I'm referring to is a value called intrinsic value. Intrinsic value. Sometimes you may see it referred to as fundamental value. So what is intrinsic value or fundamental value? And why is that the most important value that we should be looking at as business owners? So the way that it's defined is it is a true value of the business based on a fundamental analysis. It's the value of a company determined through a fundamental analysis without reference to market value. So we're not even looking at market value in any way. We're going to look at the underlying value of the firm separate from its share price. So we don't care about the book value. And we're going to look at both quantitative factors. So that's the capital, the earnings, the revenue, and qualitative factors. That's management quality, intellectual capital, culture, et cetera, et cetera, et cetera. So fundamental value is looking at all the books, the qualitative side, and the qualitative side. We're looking at the numbers and all the soft things together. The reason why that is important is because if we can drive the intrinsic value of the company up, we're looking holistically at the company, then we're going to also drive all the other values through the roof. We're going to increase those values. If we focus on strictly book value, then we could lose some value in the fair market value. If we're trying just to drive fair market value up, then we could lose some value in the fair value. But if we focus holistically on the company and focus on intrinsic value, then we're looking holistically at the company. We're not just looking at the accounting side. We're looking at all the soft skills that buyers may be willing to pay for. And if we can work on that, then we can increase the overall value of the company. So I wanted today to spin and show you that whenever someone says the value of the company, what are they talking about? Well, they could be talking about a number of things. They can be talking about any of those values. They could be talking about collateral value. I don't care about any of those values. What I'm focused on for this particular series is how can we increase the fundamental value of the company, the intrinsic value? How can we increase that? So in our next episode, what we're going to look at is the various approaches to how to determine the value, the fundamental value of the company. See, if we understand what the value is, we understand here's what fundamental or intrinsic value is. It's looking holistically at the quantitative and the qualitative together. And we understand how that number is calculated. So we understand what it is and how it's calculated. Now we can work on the areas which will increase the fundamental value of our company. So if we understand the methodology, now we know how to deal with a beast. And that is value. So with that, I want to thank you for joining me on the Financially Simple podcast. Man, it's detailed, I know, but we're going to try to continue to simplify this thing down. As always, today's show notes can be found under financiallysimple.com under the heading podcast. And hey, while you're there, I want you to look at the newsletter. I'm going to do something a little different. I'm going to invite you to join me on social media. I've been getting a lot of really good questions from people on Twitter and LinkedIn and Facebook. I even got one the other day from Instagram. So if you're listening to the podcast or if you see something out there on the Financially Simple empire that I'm trying to create, reach out to me on social media. Shoot me a message and say, hey, Justin, I heard you on this. I'm getting a ton of questions every week, and I do my best to reply to each one of those questions so that we're adding value across the board. See, there's another type of value. Hey, like I say every week, life is hard, life is good, and dude, value, probably your head is spinning right now. We're going to simplify this down a little bit more. Just remember, money doesn't have to be complicated. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.